Emily Chang, and this is the Best of Bloomberg Technology, where we bring you all our top interviews from this week in tech. Coming up in the next hour, President Trump stepped back from the brink on China, deciding against the harshest measures on Chinese investments in the U.S. We discuss what it means for China tech companies like Xiaomi and Alibaba. Plus, we talk to the man leading Uber's legal battles on the heels of the ride-hailer getting a shortened license to operate in London. Tony West, Uber's chief legal officer, joins us ahead. And the U.S. Supreme Court upholds President Trump's travel ban, giving him a legal and political victory on a controversy that has defined his presidency. We will hear from a tech leader speaking out against the decision, Airbnb's Chris Lehane. But first to our top story. The White House is moving forward with plans to limit Chinese tech investments, but in a less confrontational manner than previously reported. The president is looking to Congress to strengthen the Committee on Foreign Investment, also known as CFIUS, to keep companies from stealing U.S. intellectual property. Treasury Secretary Steven Mnuchin hailed the move when talking to reporters on Wednesday.
The economic team recommended to the president, when this legislation passes, we will have the necessary tools to protect technology, whether that's China or anybody else. So
we discussed with Bloomberg's Shelley Banjo in New York, a senior reporter who covers the Chinese tech scene, and from Beijing, Ben Harburg, managing partner at MSA Capital, a venture fund that has invested over $1 billion in the last 3 years.
Donald Trump is going to rely on Congress and the legislation that's going through right now to strengthen the laws that already exist with CFIUS. So what we're going to see is CFIUS be strengthened. It's an already kind of a untransparent, pretty interesting kind of group of folks that are managing and kind of looking at each individual investment coming in through China. And what they want to do is strengthen that even more. So that means taking a look at things like joint ventures, which used to be something that kind of flew under the radar, and smaller deals that used to kind of fly under the radar. And this idea that we're not just going to look at the big deals, but also some of the smaller deals coming out of China, trying to buy up U.S. tech companies.
Ben, as someone who's investing in China and U.S. technology, how does this impact your strategy?
Thanks. Yeah, we looked at this as a boon locally, frankly. We thought that this type of aggressive action actually led to greater drives of self-sufficiency locally. A lot of emphasis placed in the last couple of weeks amongst government, regulators, universities, venture capital firms to start to breed a new crop of deep tech businesses here to replace the U.S. components that might have been taken out of the market. I think this action and things like the ZTE sanctions open people's eyes to how empty a lot of the businesses here when it comes to core tech. And so it really spurred a deep soul searching within the venture and entrepreneurial community here, and led to a push over the last few months towards businesses really being developed, a lot of capital pouring into new areas where we believe we can develop self-sufficiency locally. So not an unexpected move here, but one that I think has started a process where you'll see even more innovation and development in hard tech and deep tech here in China.
What's been the reaction there from people in Beijing as these dramatic developments have played out, gone back and forth, the tit for tat?
It's been it's been a bit of a roller coaster. As an American here, I'm often referred to and questioned what the true meaning of all the measures is, and what really is going to stick to the wall and what is not. I think that the overall view here is that Trump is a businessman. He understands the impact that these types of measures would have both on U.S. businesses as well as the shareholders there. Likewise, many of the Chinese businesses are obviously backed by venture capital firms, much of that money coming from U.S. investors as well. And so the view here was that while a lot of these what we call extreme pressure measures were being used, ultimately a way would be found so that a lot of the impacts of these statements would be mitigated, and so ultimately not huge damage done to local businesses.
We are, of course, already hearing from lawmakers. Take a listen to Senator John Thune, who is on the Senate Finance Committee.
I think that this is a better course of action, and they indicated that they're going to use a legislative approach as opposed to what they were talking about previously, and I think that makes more sense. And if you look at the concerns that we've had about potential retaliation from China with respect to what the administration had been proposing, I think this is sort of walking back from that a little bit, and to me represents a more thoughtful, logical approach.
Shelley, what exactly are we expecting in terms of legislation to come out of Congress?
Well, we're expecting this kind of souped-up CFIUS bill and legislation, and it's going to mean more. It's going to be basically more scrutiny, more staffing involved at CFIUS, more scrutiny over the companies that are, engaging in these deals. And we've already seen the impact. So we've already seen deal flow in China from Chinese companies and acquirers into the U.S. go down. We've seen some venture capitalists pull back. Chinese venture capitalists pull back a little bit, and the idea is that maybe that's going to happen more if the U.S. increases the scrutiny. But to Ben's earlier point, there's nothing like telling someone you can't do something to kind of rev them up to do more. And so if you're going to tell Chinese companies like, you can't invest in our businesses, you can bet that's going to rev some of these entrepreneurs up to say, you know what, maybe we don't need to invest in U.S. startups. Maybe we need to double down and create our own technology. And so, it's going to be interesting to see what happens next. Is this stick going to actually end up spurring even more tech and more innovation in China than what people were expecting in the first place?
Well, and we've already seen Chinese IPOs not performing perhaps as well as expected. Take a look at my Bloomberg here, and this chart showing recent HK listed IPOs. We do have Xiaomi coming up, and Ben, you were an early investor in Xiaomi, and I understand the founder of Xiaomi is an investor in one of your funds. Any concerns about how Xiaomi will perform, given now that we know some of the financials, which aren't perfect?
Yeah, it's not an easy time to come out right now. As you mentioned, a number of underperformers in Hong Kong, this new regulations around CDRs in China, and that option being taken off the table for mainland investors, certainly frustrating many. And so not an easy time to come out. And that's certainly complicated by the fact that Xiaomi are a new species. They're a company that don't fit any of the usual metrics and valuation methodologies, and certainly company profiles that most in the public markets understand. It's a hardware company. It's a software company. We do IoT, e-commerce of services. So it's difficult to put one finger on it. And the net result is that I think a lot of people are scratching their heads today, both institutional as well as individual investors, trying to figure out how really it should be valued.
That was MSA Capital Managing Partner Ben Harburg and Bloomberg's Shelley Banjo. Meantime, Chinese smartphone maker Xiaomi is on its way to a potential $6 billion plus public listing, marking what would be the biggest IPO in 2 years. But it may have hit a snag in its hopes to reach a $100 billion valuation by postponing the mainland China half of its listing. Bloomberg's chief North Asia correspondent Stephen Engel reports from Beijing.
Xiaomi's decision to postpone a simultaneous listing in Shanghai with its Hong Kong IPO could hurt China's ambitions to lure its larger tech companies to list at home via China Depository Receipts, or CDRs. The Hong Kong IPO is set to be the world's biggest in nearly 2 years, to raise about $6.1 billion, but it's a considerably shaved down offering that originally was expected to top $10 billion. And the company's CFO says there's no time frame to revive the domestic part of the listing. Sources say Xiaomi scrapped the CDR offering because of differences with the regulator over valuation, but Xiaomi says it had no dispute with the CSRC. Now, investors, though, may dispute Xiaomi's valuation. The IPO is said to be marketed at up to 29.3 times forecasted 2019 earnings, making it more than twice as expensive as Apple and even a little bit pricier than Tencent, China's biggest internet company. Now, Xiaomi says it deserves a premium in valuation because it sees itself as an emerging internet and e-commerce company rather than simply a lower-margin smartphone player. The IPO likely begins trading in Hong Kong July 9th. Stephen Engel, Bloomberg News, Beijing.
Coming up, the travel ban's impact on Silicon Valley. We are going to hear from Airbnb's Chris Lehane next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. This week, the United States Supreme Court has voted to uphold President Trump's travel ban. The court voted 5-4 along party lines, rejecting arguments that Trump had exceeded his authority and violated the Constitution by targeting Muslims. The current version of the travel ban targets visitors from 7 different countries, 5 of them predominantly Muslim, and indefinitely bars more than 150 million people from entering the United States. Following the ruling, the president took to Twitter, saying, "Supreme Court upholds Trump travel ban. Wow." Tech pushed back big time on the travel ban the first time around. And it's back again. Among the first to react was Airbnb CEO Brian Chesky, who tweeted, "Travel ban was wrong from the beginning, still wrong today." Airbnb's co-founders released a statement saying, "We are profoundly disappointed by the Supreme Court's decision to uphold the travel ban, a policy that goes against our mission and values. To restrict travel based on a person's nationality or religion is wrong. We believe that travel is a transformative and powerful experience, and we will continue to open doors and build bridges between cultures around the world." Chris Lehane joined us on Tuesday. He is the head of global policy and communications for Airbnb and a former White House official in the Clinton administration.
What Brian tweeted, our CEO and our founders have talked about, really is getting specifically at what our concern is. And this is just based on our philosophical values. If you look at the history of the United States, core and fundamental to our history has been the sense of travel. Travel has always advanced the human condition. And we're now in a time period where you're having travel bans, controversies about children being separated from their parents, conversations about building walls. And that is fundamentally inconsistent with what it means to be American, about the American experience, about American democracy. And if you look at the course of human history, right, whether it's migration, whether it's immigration, whether it's exploration, whether it's innovation, travel has always been at the center of that. And so we do think this is really a fundamental question about whether we want to continue to move forward as a country or whether we want to go backwards. And so for us, this really doesn't involve our business from a dollars and cents perspective, but really involves our values. And, I can't help but think that on this day, 55 years ago, in what was then West Berlin, President John F. Kennedy gave his memorable speech about tearing down walls. And today you have this Supreme Court ruling, the Statue of Liberty is crying.
You also had quite a strong statement about the family separations. The co-founders of Airbnb said ripping children from the arms of their parents is heartless, cruel, immoral, and counter to the American values of belonging. The U.S. government needs to stop this injustice and reunite these families. We are a better country than this. You're matching donations to the International Refugee Assistance Project. You've been hosting guests, actually, as part of your refugee program. How many people have you hosted as a result of that?
So we've been on this for several years now, really beginning at the end of 2016. We did an ad around the Super Bowl, made a series of commitments, including housing 100,000 displaced people, I think well over 11,000 at this point, contributed $4 million to help support refugee efforts. Today, we're announcing that matching program with the International Refugee Assistance Project. And so, for us, it's not only about speaking up and standing up, it's also about, putting action behind it. We are a community-based platform. You know this. We have 5 million plus listings around the world, and we work with our host community to help open up homes for people who are displaced. And we're going to have more to say about this, as we go forward, because again, for us, this is a values-based issue. But to the extent that you even want to talk about it from a business perspective, think about what's happened, in this country over the last year, right? You've seen travel go down. Travel's 10% of our global GDP, similar in the United States. Here's 100 million jobs that are going to be attached to travel over the next 10 years. And these types of decisions are just fundamentally not good for the U.S. from an economic perspective. Again, for us, I really want to underscore, we've continued to grow, even as the rest of the travel industry has been impacted by this in the U.S. So for us, it's not a business, it's a values. But I've actually referred to some of these decisions as as travel tariffs.
Right.
Right? Once you start to impact travel, you're impacting a significant economic sector in the U.S., and that's just not big companies, right? That's those restaurants that depend on it. That's the small businesses that depend on it. We're speaking out about this, and we have been speaking out about it. We talked about it over when the comments were made about the various countries. I won't use the word that was used when the initial travel ban was announced, when other issues have come up, such as the separation of the parents and children at the border. So we're going to continue to talk about it. It's germane and material to what we stand for from a values perspective. But there are obviously business issues out there.
Right, and it does impact your business if travel is down. I mean, how has travel, from Airbnb's perspective, been impacted not just by the travel ban, but by the American first mentality and President Trump's general anti-immigrant stance?
Yeah, so it's a really interesting question. So if you look at, and other travel groups have put out this information, that travel to the U.S. over the last year from international origins has gone down. We've been very fortunate in that we've actually seen our travel from those international origins go up. We think in part that is somewhat reflective of the fact that people are actually coming to stay with other real people. And so in some ways, our model actually works for those folks who want to come and spend time with real people. But yes, overall, when you're out there putting out travel tariffs and travel bans, that's certainly not going to be good for that particular economic sector. But for us, I think this really implicates a much bigger issue, and that is this question of whether we're going to have an open world or a closed world. Right? We face enormous global challenges: climate change, economic inequality, conflict from all sorts of forms. Right? The only way those issues are addressed in a global economy and in a global context is with countries working with one another, and that requires a mindset of an open world. Right? Isolationism to tribalism, it's pretty clear that has never worked, and it's not going to work.
Do you worry about being so closely aligned with Democrats from the perspective of your business, but also some of your employees who may be Republican, who may sympathize with the president's policies?
Well, for us, right, we speak out on issues that go to our values. Travel is inherent to our values. We don't look at this as a DR, Democratic, Republican issue. I think people know where I come from philosophically, but we as a company look at this really as a question of moving forwards or moving backwards. That's the prism that we're using. We don't speak out on every single issue that takes place out there, but we do speak out on those issues that go specifically to our values. And at the center of what Airbnb is all about, it is a sense of belonging, of driving belonging, of promoting belonging, of having people stay with different people from different backgrounds. And so when you get rulings like this, those are just entirely inconsistent with what we're all about.
But surely there are people who work at Airbnb that might disagree.
I think that anyone who works at Airbnb has signed up to support and promote belonging. It's one of our core values. We actually have a core value that talks about the power of belonging, the transformative impact of travel. And so when you come to work at Airbnb, you're coming to support a community that is committed to driving belonging. And I think people understand that when issues come up that are going to be inconsistent with that, whether it's here in the U.S. or in other parts of the world, we're going to stand up for the issues and values that our community cares about.
Now that this has happened, is there anything that you're doing behind the scenes on the business side to adapt?
Yeah, well, we're certainly going to be releasing some more information today. In fact, we're going to be releasing a video in a very short time period that actually is going to communicate how strongly we feel about the power of belonging, the power of travel, how important it has been to the American experience and American democracy. And we're going to continue to work on some of the things that we've been out there on, right? We've today announced that we're going to do a matching fund to IRAP, the International Refugee Assistance Program. We're going to continue to find ways to house people who've been displaced. Because again, this all tracks back and rolls back to our values and our purpose.
Coming up, China's booming tech sector. GGV Capital's managing partner Jenny Lee tells us where she sees the most growth and opportunity. Next. And later this hour, Uber gets a second chance in London. The details of the ride-sharing service's 15 months license to operate there. This is Bloomberg. Airbnb, Xiaomi, Alibaba, Didi, and Grab are among 22 unicorns that have one thing in common: investments from GGV Capital, a firm with nearly $4 billion in assets under management. One of the driving forces behind GGV's success is managing partner Jenny Lee. Lee is a frequent present on the Forbes VC Midas list, and she was the top woman on the list and number 10 overall in 2015. She sat down with Bloomberg's Tom McKenzie in Shanghai as part of our Venture China series to explain where she sees the most growth coming in the Chinese tech sector.
The first area of focus is around the whole evolution of consumer, buying habits and changing, right? So we actually call it our e-commerce kind of upgrade strategy. So in this area, we have invested in, some of our earlier deals includes companies like Alibaba, companies like Wish that does cross-border e-commerce. What we are seeing new innovation that's happening is actually in offline disruption. So the online companies are leveraging data that's been collected from consumer to now try and serve them better, not just online through just e-commerce, but also offline in terms of what they are shopping and buying offline. So this is happening in formats like smart unmanned, convenience store. So that's a big piece for us, online e-commerce, integrating into offline and disrupting the offline traditional experience with data. The second area of growth for us is always around social. So if you think about, sitting in the US, before we always like to say, if you're a VC who finds a Facebook every 10 years, then you're great. But you can only find a Facebook every 10 years, right? Whereas in China, you can always find like a Facebook-like type of a business model every 3 to 4 years. Every 3 to 4 years, there's always new social disruption, whether it's in the form of short-form video, whether it's in the form of live streaming video. But the key, it's actually content and feature driven and targeted towards each of this different segment of users. We have investments in companies that's the #1 fitness app in China. We have investment in a company that is the #1 square dance app in China, targeting the women that I talked about. We have another investment in a company that only targets the Generation Z. I think there's quite a bit more room for growth within social, and therefore expect to see these companies maybe taking that model overseas as well.
Do you think some of those examples around social can be moved overseas? Because we haven't seen that many success stories of Chinese social tech migrating overseas successfully.
Well, it's starting to happen. We have an investment in a company called Musical.ly. Chinese company, based in Shanghai, but they launched the app in the US a couple of years ago, and it's like the top 5 or 10 social app in the US. Recently, the company was acquired by Toutiao, but it's really an example of a Chinese featured, Chinese developed app, making it and becoming #1 in the US market. In fact, we've also seen Chinese apps, social apps, not just going to the US like Musical.ly, but they're also going to Southeast Asia. For example, YY, which is a Chinese company, has a similar app called Bigo, which is one of the largest social app in Southeast Asia.
How many exits are you looking to pull off by the end of 2018?
Over the last 2 years, I've had over 6 M&A exits. This year it's going to be IPO. So this year the firm has around 6 to 7 companies preparing for IPO, both domestic and overseas market. And I have 4 of the portfolio companies on the board of them.
Given that you are based both in Silicon Valley and here in China, how do the Beijing-Washington trade tensions play into your decisions? Are they having an impact on the way you operate?
Well, so we are watching the development very, very carefully right now. We need to know which direction this is going to go. I think that in the short term, we feel that both countries will not benefit, right, from increased trade tension. Longer term, though, China may come out ahead.
That was GGV Capital Managing Partner Jenny Lee speaking to Bloomberg's Tom McKenzie in our Venture China series. Coming up, we will hear from Tony West, Uber's Chief Legal Officer, on what it is like to have one of the most challenging jobs in Silicon Valley. And Bloomberg Technology is live streaming on Twitter. You can check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Welcome back to the Best of Bloomberg Technology. I'm Emily Chang. A judge granted Uber a 15-month license to operate in London after the ride-hailer made some changes to appease regulators. The ruling came Tuesday after 1.5 days of arguments in which lawyers for Uber insisted the global ride-sharing app had completely overhauled its culture, passenger safety policies, and reset its testy relationship with the regulator. Bloomberg's Caroline Hyde caught up with Bloomberg Tech's Nate Langston in London for the details.
They've got 15 months now to basically make good or continue making good on a lot of the promises that they've said they're going to make, behaving a little better and, reporting crimes and offering, a bunch of other changes that TfL now actually has said, yeah, we're kind of happy. So it's this 15-month period that they've just got to keep going, keep doing the right thing, and then eventually reapply for another license in 15 months' time, and hopefully they'll get that without having to go to court.
I mean, you did some fantastic reporting by getting into an awful lot of Ubers, and generally the consensus was the drivers certainly like the product and they want to keep the flexibility.
Exactly. The number one piece of feedback that I had is that, yes, having benefits would be very, very nice, thank you very much, but it's all about the flexibility. They're not competing with the black cabs that we have here in the city because they are competing with minicabs, the kind of private hire license, and this is a change for them to be their own boss and work whenever they want. So that's the number one thing they want to keep.
It's notable for Uber, though, that this doesn't end the legal battles that are in the UK, because when it comes to the drivers, there's still some hurdles they're going to have to jump in terms of giving them not just the insurance packages they already have, but more worker benefits.
Potentially, yeah. This is battle 1 of 2 for this year, and battle 2 will be in October when they'll be in court over employment. So Uber lost an appeal about employment rights and holiday pay, vacation pay, things like that. And we very recently had another company operating in the gig economy with plumbing, so a little different to ride-hailing. It was a company called Pimlico Plumbers, and they lost a case, and one of their workers was given the right to vacation pay. And so, it's one of the first times we've ever seen anything like that. And, Uber's going to have to go into court knowing that some other company with a set of workers very similar to theirs has been told that he can have vacation pay. So
does this sort of undermine the business model going forward, or is Uber here to stay, their number one market in Europe, in London, and really this is a takeaway of good news for Dara Khosrowshahi?
I think that, for Uber, having to pay for things like insurance, even vacation pay, it's a lot less expensive than it would be to pull out of London. London is the biggest market in Europe and one of its biggest worldwide. And so, for Uber, it's a no-brainer. It has to do what it needs to do to stay here. And if it has to pay, vacation pay, then I have no doubt that it will do. And at the same time, Uber doesn't really have a direct rival here. In the US, there's the twins of Uber and Lyft, but we don't have that. Some people say it's Uber and the black cabs, but they're actually very, very different business models, and they serve quite a different audience or type of passenger, rather. So, Uber probably needs to sort out the legal battles first, but it also needs some competition here.
Caroline Hyde there, along with Bloomberg Tech's Nate Langston. We continue the conversation with Uber's chief legal officer, Tony West, who was recruited by CEO Dara Khosrowshahi. I spoke with West about how he is tackling his big challenges ahead at an event hosted by Bloomberg Law in San Francisco, and asked him about the company finally getting its 15-month license to operate in London.
It's a win that requires us to walk the walk and to demonstrate that we are, in the words of the license, fit and proper. And I believe that we would not be here at this point had we not, in the preceding 7-8 months, where Dara, I think, really engaged in some extraordinary personal diplomacy. We would not, and there's been a lot of other things, changes, significant changes, structural changes, compliance changes that we have made to the way that we operate. We would not have gotten to this point had I think TfL and other observers really sensed a change in the way that we approach that market and the way that we're operating.
A representative for the taxi drivers suggested that you could be an Uber in sheep's clothing. Should we be worried about an Uber in sheep's clothing?
Well, the new Uber is what you see, right? I think that I think what I can say is that it behooves us to be as transparent as possible. It behooves us to be as upfront as possible. It behooves us to take accountability for things that went wrong, take credit for things that go right, and to be as open and upfront about where we see the company going. Look, we know a couple of things. One is Uber survives only if people trust us. Simple as that. They've got to trust us with their data. You have to trust us with your safety or the safety of your loved ones. And we have to earn that trust every day in the way that we operate. That's the mandate. And if we don't do that, we're going to lose. Simple as that. And so as you think about Uber being the mobility platform of the future, a place that you not only go to because you want to ride in a car, but because you want to get on a bike, because you want to take another mode of transportation. Soon you want to get into an air taxi, right? When you think about the platform in that way, as a mobility platform, the idea and concept of trust and safety becomes even more important. And that means that it's got to be what you see is what you get.
The California Supreme Court recently ruled in favor of drivers for a document delivery company, which could have wide-ranging implications for Uber and other gig economy companies. Is Uber at all considering proactively making its drivers employees rather than contractors?
So, I think the Dynamics decision is a big decision, and the implications are far, far broader than just ride-sharing companies. Clearly, it affects us, but many more who use an IC model, an independent contractor model. And I think what it means is we have to kind of back up a little bit and be willing to engage a much broader, much more fundamental conversation about the gig economy and the opportunity that we want to create for individuals who participate in that economy. And so, what that means is, we have to have an honest conversation about, there doesn't need to be this false choice between security and flexibility. You ought to be able, in today's world, to have flexibility and security. Again, the partnership with AXA in the EU, I think, is a demonstration that you can do that. We have something called we contribute to something with other rideshare companies in New York to something called the Black Car Fund, which is actually administered by labor, but tries to essentially do what we've done in Europe for drivers in New York, and I think it could be a model for the rest of the country. But that really does require that we kind of come out of our ideological crouches and we engage an honest conversation about how can we make sure we create more and more opportunity in this new economy, which is not a whether, it's here. We have to grapple with it. We have to deal with it. Let's make sure we do it in a way that creates opportunity for everybody. Could drivers become employees as a result? I mean, are the implications that big? I mean, the implications, it's possible. I think, that could be one result. I personally don't think that's the right result, because I think, at least in our business model and in the business model of so many others, that means that there is a great degree of flexibility that is then taken away. And there's a question of whether or not, that kind of business model can be as efficient and as effective. I think one of the things that's so important when you think about an Uber is the vast, vast, vast majority of our drivers, they drive less than 10 hours a week. Okay, so these are individuals who are supplementing their income. They're individuals who are finding a way to drive on their schedule, on their terms. They ought to be able to not only engage in that practice, but have protections for them while they're engaging on the platform. And I think that's the win-win that we want to get to ultimately. I would be remiss if I did not ask you about multiple criminal investigations that your former employer has into Uber, including one that the company paid bribes overseas, Greyball, where they used fake cars to avoid law enforcement, all of this allegedly. Hell software that was used to track Lyft drivers, whether Uber stole trade secrets from Waymo, and whether Uber violated pricing anti-discrimination laws. Any updates? I now know what it feels like to be on the other side of me a few years ago. Look, without confirming any of that, I will say this. We continue to be very cooperative with regulators who are investigating a whole host of issues. That is the approach that Dara believes in. It's the approach I believe in. I think a couple of challenges that we engaged when we started. One was cultural change. That was job number one. As anybody will tell you, the most important, any CEO will tell you, the most important thing about a company is its culture. Everything else is secondary. So that was job number one. But the other thing that we really had to do is, work on the what I call the regulatory shadow, the overhang that we want to continue to methodically move through. Fortunately, one of the things I encountered when I got to Uber was an incredibly talented team of lawyers who have been working on this and continue to work on this. And I think they now are working in an environment where we can engage regulators in perhaps a more cooperative way than has been the past, some observers may say. And I think that is benefiting the company.
Sticking with ride-hailing services, one of Uber's main rivals, Didi Chuxing, is making a push into the Australian market, launching operations there on Monday. Bloomberg's Paul Allen filed this report from Sydney.
It's a slow and steady start for the launch of ride-sharing service Didi Chuxing here in Australia. The company's been trialling its service in the small city of Geelong ahead of its launch in Melbourne today. But here in Sydney and the rest of Australia, well, we're going to have to wait. The Australia and New Zealand boss Dylan Yee says Didi will take a pragmatic step-by-step approach to expansion, with feedback from the Melbourne launch used to shape offerings and launches elsewhere in the country. Didi's been raising capital to fund its expansion. A $4 billion funding round in December raised its valuation to $56 billion, with sources saying the company has cash on hand of $12 billion. Discounts of up to 50% are going to be offered to riders until the end of July, while drivers who sign up early will qualify for incentives as well. The ride-sharing market in Australia is getting a little bit crowded, though. We already have Uber here, and Didi's going to be joining Taxify and Ola as well on the streets down under. Paul Allen, Bloomberg News, Sydney.
Coming up, we sit down with the CEO of Africa's biggest company by market cap, a company that has also made perhaps the best tech investment in history. Naspers CEO joins us to talk about backing Tencent next. This is Bloomberg. Last week, Africa's biggest company by market cap reported a 72% increase in full-year earnings. Naspers credits classified advertising and its e-commerce business for this boost. Naspers also happens to be one of the biggest, if under-the-radar, tech investors in the world, and has long relied on its 31% stake in the Chinese tech giant Tencent to accelerate profit growth. But its investments in new online companies are starting to bear fruit. Naspers raised $9.8 billion in March by selling a 2% stake in Tencent. The company then netted another $1.6 billion profit from the sale of a stake in Indian e-commerce startup Flipkart to Walmart in May. Naspers CEO Bob Van Dijk joins us to discuss.
The main reason why we freed up more capital is really driven by opportunity. So we've been focusing, building our e-commerce business in classifieds and in payments and in online food delivery, and we're getting to some scale, and we realized there's so much further opportunity for us to pursue. And we really wanted to shore up the balance sheet and give us the capacity to do that. Sort of to repeat that model of finding a great business, finding a great entrepreneur, putting our backing behind them and making a great company grow.
Well, to walk away from even a small stake in Tencent is a little bit risky, given how fast the company continues to grow. Where do you plan to put this money? Where do you see that opportunity?
Yeah, so what we see basically of course, Tencent is an amazing company, probably one of the most impressive growth stories anywhere in the world today. But what we also see is that we've managed to build excellent businesses in 120 countries in the internet, and we're just not done. And we realize that if we continue to be looking for the right entrepreneurs, we find them, we actually trust them. We give them a lot of runway. We can actually do this again and again. And a good example is what we've done with Flipkart in India, where we've also found an opportunity really early. And we backed a founder that was in 2007 in India looking at an e-commerce dream, wanting to build this great e-tail business while there were no credit cards, there was no logistics, there was no structured retail. We backed him from early on, and he's made something great happen, and that's what we do.
You bought that small stake in Tencent back in 2001. It's now worth upwards of $150 billion. You know, I'm sure there's been some fascinating drama over the years, whether to get into games or e-commerce. You've been ringside for all of this, and I'm curious if you could share a little bit more about your shared history. What's it been like to be on the front lines of Tencent's growth?
No, it's been a fantastic ride, and as I said, it's probably the company that is run by the most incredible leadership team in the world. And I think what they've done structurally well is they care about their customers. They start with their customers, they start with technology, and they've been basically taking a view on what is the best possible product we can offer. And that's very much what we do as well in our other investments. We find these entrepreneurs with a extreme product and customer focus, and we back them. I think Tencent is by far the best example of doing that, but that's fundamentally what we do in Naspers.
Your stake in Tencent is now worth more than Naspers overall, and your performance has largely mirrored Tencent's. What is your strategy to close that gap?
Yeah, no, we are, of course, a company that's quite diversified. So you would expect a certain discount to be for us normal to trade at. I think for us, there are some structural other factors that make our lives a little different from others. But fundamentally, what we are focused on doing is find these great entrepreneurs that build great businesses. And actually, the last set of results are a good example where we've seen very strong growth in our e-commerce business, growing at close to 40%, accelerating year over year, and our core e-commerce investment classified turning profitable. So building great businesses, that's really what we do.
So you've said you look at listing some business units individually. Curious, which of your businesses do you think are listing ready?
Yeah, I think at this point in time, we're just looking at a broad set of options on which businesses actually can help us over time to unlock this value. And look, there's a broad set of options we have. We've done it many times in the past, right? For example, we invested in a online food delivery business called Delivery Hero. A while ago, that company went public and has been on a fantastic ride. So we actually look at it all the time. We look at which businesses would be better off if we would take them to a public situation, and we make those choices.
That was Naspers CEO Bob van Dijk. Coming up, Salesforce has announced a $2.5 billion investment in the UK over the next 5 years. We'll talk to the UK Secretary of State for Digital Culture, Media and Sport, Matt Hancock, on all future tech investments into the UK next. This is Bloomberg. Once again, the UK government is making it a point to show off the country's tech scene. Despite the distractions of Brexit, the UK is hoping to secure the economic rewards of being a destination for AI and cybersecurity investment and implementation. This week, it helped unveil the London Cyber Innovation Centre just weeks after announcing billions of dollars of new investment in the tech sector from overseas, with Salesforce among the international companies showing some love. Bloomberg's Caroline Hyde spoke with Matt Hancock, UK Secretary of State for Digital Culture, Media and Sport, in London.
Large technology companies from across the world not only are welcome here to invest, to expand their operations, but they're doing so with great pace. Salesforce, you mentioned, over the last 2 years, we've had major investment decisions from Apple, Google, IBM, Amazon, a couple of weeks ago, further news from Amazon, Samsung opening their facility in Cambridge. There's massive investment. As I say, it doubled from 2016 to 2017, the tech investment in the UK, and we want to keep it pushing in that direction.
What about about the regulatory environment? Because at some points people, particularly the Silicon Valley tech giants, look at the EU in particular and feel, I mean, we're being slapped with fines. We feel that copyright law now is going to tackle the likes of Facebook and Google. How much do you think the UK's regulatory environment is a blessing or a curse for some of these big companies?
Well, we think there's an opportunity here too. The UK traditionally has got a good track record of writing regulation that both gives us a framework within which people can operate, but also is very strongly pro-innovation. I take the regulatory sandbox that the FCA has developed for fintech as a world-leading example of, yes, of course, having regulations because financial products do need a level of regulation, but also allowing for innovation, having the presumption that something's okay, and if there's a problem, the regulator will have a conversation, as opposed to the other way around, that you have to have something approved before you can move anywhere. So we have a very pro-innovation regulatory stance. We're constantly changing the law to try to update that. For instance, before Parliament today, there's the autonomous vehicles bill, and that will help to make us a great place to run autonomous vehicles safely and securely in the interests of citizens, but harnessing the new technology. And likewise, the Data Protection Act brought the GDPR, the European legislation, into UK law, but also exercised a number of derogations to be more pro-innovation than if we just brought it in wholesale, within the limits of what GDPR allows. We think that that is a really good rule, and even though we're leaving the European Union, we're going to keep it because we think it's a good balance between privacy and innovation.
Some of our innovative companies that have been born and bred in the UK, the likes of Sky, are so innovative that become targets. What do you think about the consolidation within the media space as well, as being yourself, digital, culture, media and sports?
Well, I certainly see it happening as I'm the quasi-judicial decision maker in some of these mergers, so I'm very careful to ensure that the decisions are taken clearly and objectively based on the evidence. We obviously had a very detailed process with Ofcom and the CMA looking at the Fox takeover of Sky. The final details of how that can work without causing problems in terms of media plurality are now out for consultation for the next week or so before we come to a final decision. Also, the Comcast proposed takeover we looked at and decided that didn't raise concerns. So that's now there'll be a takeover contest. Should that proceed as billed, and I think that the position that we take in the UK, that the government doesn't take a strong view on these mergers generally, outside of these specific rules, both competition and media plurality and the media rules around mergers. I think the fact that the politicians don't then express a view between different potential bidders, I think that is a real strength for our economy. It's one of the reasons we get so much investment here, and so I'm going to keep abiding by it.
That was Caroline Hyde with Matt Hancock, UK Secretary of State for Digital, Culture, Media and Sport. And that does it for this edition of the Best of Bloomberg Technology. We will bring you all the latest in tech throughout the week. This week, we'll get Tesla's latest delivery numbers following a company reorg, job cuts, and its ongoing quest to turn a profit. Tune in for full coverage each day, 5 p.m. in New York, 2 p.m. in San Francisco. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok, on Twitter. This is Bloomberg.